There's a lack of understanding or education around the product and how it should be used.
It's important as well for our listeners to understand that it's not, you don't just make these mistakes if you are new to trading. You're more likely to make them when you first come to trading.
His point is like, I get bored and I overtrade. And that was one of his pitfalls, his downfalls.
Yeah, but you're not thinking, well, what could I lose? And the likelihood is when you trade in choppy waters, you're going to get
chopped up. Emotional bias, emotional psychology, it can be a killer. Welcome back to Talking Shop with IG. I'm your host, Luke Moore, and I'm joined by the original three amigos, or the two amigos, making me the third.
Getting the old band back together again.
This is it.
It's been a while. Feels like it's been a few weeks, a few episodes now.
Yeah, because you never turn up.
Champion the client first. Now meeting clients.
Loves it, always selling.
That's what he says. That's what he says. It's because the free lunch is on Monday. You don't want to come in on a Wednesday, which is when we record these.
I go for a free lunch with the client on a Wednesday.
Oh, there you go.
Yeah, exactly.
I'm joined by Sean Power, of course, and Pete Ward. And this week, we wanted to summarise a bit of what we've been talking about. So this year, we've been talking about our Tradecraft series. So how can we help educate? How can we help clients take information, pick our brains? What can we pull on our experience to kind of distribute some learnings? So today, we're wrapping that up. We're filming and recording the day of Liberation Day. So it's going to come out probably after Trump's tariff announcement. So if you're listening to this, congratulations, you've survived.
You made it through.
We're here to fight another day. And so we're going to talk about the top 5 mistakes that retail traders make and what we can do to avoid them. So we've been around the business, we've spoken to analysts, we've spoken to people in the business, and we've come up with a list of what we think are the 5 most important things that clients need to avoid to try and guarantee their success. And these are things that we've spoken about the last couple of episodes. We're just going to rattle through them, and we want to make sure that we are getting them to you. So the plan is, if we cannot overrun, 5 things, 6 minutes apiece. Let's go, shall we?
Yeah.
Yeah, let's do it.
Cool. Right, someone talk to me about, just before I get my timer up, because I need to get my phone so that we're on time, trading mistakes. Why do people do them? What's going on?
Well, there's a whole host of reasons, right? I guess, I mean, trading isn't easy. People want to whether it's you're looking for an additional income to your job, whether it's you want to become a full-time trader, you set off on that path and maybe you're not well equipped or you're not ready to start that journey as aggressively as they do. So I think there are a whole host of reasons to go into that, whether you're, and we'll get into them, sort of overtrading, position sizes, all those factors go into it. Lack of education to begin with, which is part of the reason we do this, right? We're trying to make people informed and trying to help them on that journey. So I think, yeah, there are a whole host that we'll go through now.
And do you think being aware of pitfalls makes it easy to avoid?
No, well, I think being aware of what you could, yes, I do agree with you. But I think you need to probably have some experience of them before you take notice, really. Because anyone can read something in a book or watch a video, but until they've felt the impact of a trading loss, I guess, you don't really take notice of it. So you always need that initial pain point to go, okay, right, that's what that is. I need to try and avoid that.
And even when you know the rules and you've experienced the pain, it's still hard to implement, right? So there are all kinds of emotions and psychology that goes into why you wouldn't stick to rules that you know.
Well, that's what it comes down to, right? When you start trading, and if you trade successfully, you can attribute it probably to luck, to timing, to a lot of things. When you stretch that timeline out and you want to do it consistently, you're going to bump into these things, inevitably. Everyone does. The reason why these are common is because it's probably built into our human nature, right? So, and it's inevitable. So hopefully this is an episode that everyone's going to be able to take something from. So mistake number 1, poor risk management and poor thought around position sizing.
Yeah.
The clock has started.
I think this one's key, and this one really happens for new traders, because I think, especially with our leverage product, if you trade on spread betting on a CFD account, where you have the access to amplify your position size, you can come unstuck pretty quick if you go, right, okay, there's been a decent down day in the market, I'm going to put some money into work here because I think it's going to bounce. And rather than having an idea of your overall size that you want to achieve, you basically put it all in straight away. So you might go, right, okay, FTSE's come down. I fancy having 25 quid a point. Okay, but maybe 25 is actually your maximum you can really afford to have. And rather than going maybe, 5, and clipping in a way where you end up with an overall size, you basically go, bosh, straight in. And actually there's another 2 or 3% move down before it comes right. So I think that size thing, working out which markets you need to be what particular size in is very important. And that one size fits all thing just doesn't work. So if you're 25 in FTSE, you can't be 25 in the Dow because Dow is a 5-figure number and the FTSE is a 4-figure number. So your notional exposure changes. So it's an understanding of what notional am I happy with and what does that translate to if there's a percentage move of 5%, 10%, either for me or against me, and what P&Ls that's going to make. And then once you've got that, you're up and running, I think.
Yeah, I kind of agree. I think position sizing, people will, relative to their account size, they're undercapitalised for the position they take. So again, to your point, just going for it, almost there's a lack of understanding or education around the product and how it should be used. It's not for you, oh, here you go, here's 10 times your money, go and use 10 times. That's not what it's about. So I think position sizing, I think initially, patience and discipline come into that as well. People want to get rich quick. This is a sure thing. All those kind of things come into it. So patience and discipline, I think, are key elements to sort of negating this.
Yeah, and I think it's important as well for our listeners to understand that it's not, you don't just make these mistakes if you are new to trading. You're more likely to make them when you first come to trading. But I met up with a client yesterday. And he's been trading for a number of years with a great degree of success. And he actually mentioned to me that he took a position in gold back when it was down at 2,000. Bearing in mind we're now 3,130. He took a position of size, notional size, over $1 million in terms of position size, but had it all in one level. And it kept coming down a bit more and, put the fear into you. And you go, I'm too big. Close it, take a 40, 50, 60K hit, and then all of a sudden it's done what it's done, which is 2,000 up to 3,130. And had you gone initially, right, I'm happy to have $1 million of this, but I'll have 100,000 on leverage, and then another 100, then another 100, going with the trend as it comes up. I mean, even if you look at that chart, it's phenomenal because it's not really stopped since 25. You could have layered in with the trend being in your favour and had a lovely overall position rather than going, right, it's really low, it's going to go back up. He's right, but because his position size was wrong, he got blown out by the market. And that's the key point, and that's a professional. So it's not just newbies, it's everyone. And that's important, I think.
It's massively important. Well, we've proven we did a whole episode on position sizing, and we proved that looking at research, if you traded with a fixed stop as a percentage of your account and then let that define your position size, and then have another rule. So if you risk no more than 2 or 3% of your account on one position, and then you cap your overall risk per account to say somewhere between kind of 5, 7, 10%, depending on your tolerance for risk. We modeled how many trades you can lose in a row before you go to ruin. And I remember seeing a stat where it was with a 2 or 3% stop, there was still a near 100% chance over 10,000 trades that you would lose 5 trades in a row. So if you don't have that discipline, and if you're risking more than 10% of your account, that you'll get almost guaranteed on a large enough number of samples, large enough sample size, to halve your account size. And that's just, it will eventually lead you to ruin. But what you also find is that psychologically, clients will want to chase losses. So there's the gambling mentality that comes in here. If you lose 3 trades in a row, you're on tilt, right? To borrow that poker phrase. And it's, how do I win my losses back? And that's the worst thing to do. You should size down, let the percentage rule drive your position size lower, because then you're gradually taking on less and less risk. So your chance of ruin becomes less and less. It becomes less exciting. It becomes less of a gamble, let's be honest.
You've got to
some
avoid
people
that.
are in it for the sport, but some people are in it for consistency.
You've got to avoid the Hail Mary.
You have to.
Yeah, right. I've lost on 1, 2, 3. Here's 5 times the size, have it,
Yeah.
and let's hope for a retrace, because realistically, once that trend's moving against you, it's unlikely you're going to get that pullback.
Yeah.
And that all fits in with the sort of stats on our website about how many people lose money compared to how many people make money. And often it's that initial poor experience through lack of risk management, education. That's it. And I did some research ahead of this from a website called Trade Society. They analysed day traders. I think it's US focused. They said among all day traders, nearly 40% day trade for only 1 month, lose money and they're out. Then within 3 years, only 13%, and after 5 years, only 7% remain. And I know we've got to move on, but I had a chat with a client yesterday. He was talking about position sizing, and I said to him, you've got to look at market characteristics. If the market characteristics change, i.e. today, like Liberation Day, right? Volatility event, you're just sitting there with the same position. Should you be going into that with the same size position you had, I don't know, pre-Christmas?
No. And definitely listen back to our episode, because we spoke about ways where you can adjust your position sizes based on volatility, based on 3 or 4 different indicators, and letting that decide how your position sizes are.
And moving on to the next one, I know we've got to move on, but his additional point was, it's quiet, so I overtrade. I just boredom trade. And that moves us on to the next one, which I know is overtrading.
Look at that. Look at that segue.
Yeah, that's nice.
That's his point. Is like, I get bored and I overtrade, and that was one of his pitfalls, his downfalls. When it's quiet and there's an element of volatility which is great for trading. When it gets too much, you should be sort of downsizing in terms of size. But his point is, when it goes really low, I just sit there and just trade, and I shouldn't. That's another big pitfall.
Right. Let's move on.
Yep.
We messed up our first slot by about 1.5 minutes. Okay. So we're behind time. Let's carry on. Number 2, overtrading and the lead to excessive transaction costs.
Over-talking.
Don't worry, you put 3 people in a room that can definitely overtalk. How does overtrading affect clients? Now, I saw a stat that to be considered a day trader, trading more than 5 times per day would make you a high volume day trader. And how many of our clients do you see that trade 20, 30, 40 times a day?
Yeah.
And if you think you're crossing the spread 20, 30, 40 times a day, right, £10 a point on the FTSE is going to give you £80,000 worth of notional exposure, and you're paying 1 point for that, okay? But if you're only in the market for, say, 5 points, that's 20% of your cost is the spread. And you do that 30 times, that's going to add up. So you have to constantly be making back the money in the trade to make your costs count for yourself. That's a lot.
I think, the overtrading, boredom trading is definitely something that creeps in all areas. And I think it stems from clients putting self-imposed targets around themselves. So, if you've got to make 500 quid a week, you've got to make £2,000 a day, you've got to, whatever it is, it's relevant to you relative to your pot size. But if you put that barrier or you put that target in your own head, and it's, markets are quiet or anticipating news, and you're in that kind of purgatory phase where it's kind of going nowhere, directionless. We saw it yesterday. Market did not know what to do. No. Wild swings. I was showing you my phone because I've got alerts on the Dow. If it moves 50 points in 5 minutes, and from the open, it had like 30 alerts just showing like the chop in the market. And your risk there is that you basically go, well, I need to make some money today. And you enter on things that you wouldn't normally have entered had you done your setup, which is, checking all the things, checking your indicator, looking at the chart, making sure you're happy, stop, limit, bish, bash, bosh, all in, ready. And realistically, you're going, right, okay, I need to trade this afternoon because I've got to make. But you're not thinking, well, what could I lose? And the likelihood is when you trade in choppy waters, you're going to get
chopped up.
So I think that one stems from that. And you mentioned it, excessive transaction costs. The best traders we have, I think, we could probably all agree on this, are traders who build positions and let the market do what they wanted the market to do with a position of size. And some of the top guys that we've got, they come in, they build it up, long or short, leave it, and get that move, and then come out of it. Okay? And their transaction costs are minimal compared to their returns. And the clients that we typically find who are more active intraday, in and out, frantic trading, they typically are the ones that are racking up the large transaction costs, but also their P&Ls are small.
Yeah.
So their average win rate might be tiny. They might still be profitable clients, scalpers. People do it and they do it profitably. But your analysis is so tight between cost and P&L. Whereas you come in and you use our system to leverage your position and leverage your view, and you go, right, I think, home builders are going to the moon, right, so I'm going to buy Barrett's, all these different things. Position yourself in size and then let it do what it's meant to do. And you're paying, 10 basis points to come in, 10 to go out?
Yeah.
Well, ESMA did a study on it. So ESMA, the European kind of derivatives regulator that we have to adhere to, said that in an analysis of CFD trading back in 2018, they said spreads, commissions and financing represents 31% of all losses experienced by retail traders. So 31%. So that is a third. Just to put some data behind exactly what you just said there. So if a client has unfortunately lost money, a third of what they've lost is the transaction costs. And I'd bet my bottom dollar that those are people that are in and out and trying to play the game very quickly and will probably run losses and everything that comes around with that. But by seeing those high costs and by overtrading, you're taking a 30% haircut straight away.
And also when you overtrade, you get positions that you didn't want. And let's say the position goes against you, you end up in a losing position. But not only that, on the leverage side, you're paying overnight funding for a position you never wanted in the first place. And going back to the chat I had yesterday, and he was talking about boredom trading and overtrading. And he said, when I close it, I always think, why did I do that? I said, I bet you had the same thought when you were placing it, but you didn't answer the question. And he was like, yeah, I probably did. I probably just ignored myself. And it goes back to that patience, that discipline. You're waiting for the setup that you've planned for, whether it's a technical analysis, whether it's a news event, but you've just ignored it and just gone for it. And like I say, that holding cost, when people are just sitting there, you've got a position you didn't want, you've got it for a week, 2 weeks, a month, and you're paying for that. You're paying for the privilege of holding a losing position.
To try and get back to break even sometimes.
Yeah.
You're like, what am I doing?
To your point as well, like I know you're under the pressure to get, if you fall behind your curve you've set, let's say it's 500 quid. Okay, I've only made 300 this week, it's Friday, I need to place a trade. Just have a break. Just go, okay, it's not there. Maybe I can make 700 next week and I'll be fine. But like you say, just that pressure to meet your own goals is huge as well.
That's right. It's difficult, and the trading plan stuff comes in with that.
Let's not get too far ahead of ourselves.
Yeah, no.
Sneak peek of another one. But I just want to say the University of California also did a study onto this. And so when we're talking about these numbers of trades that are more than 5 per day, makes you a high volume day trader. They said that if you call off and you design a call off period after a series of loss-making trades, you put yourself back on the dealing floor, on the trading floor. Your risk manager taps you on the shoulder and says, "You've had it for today. You've done whatever your trading plan is. You've lost this amount of trades. Time off." They reckon that reduced subsequent trading frequency by about 37%, and therefore improved your decision-making quality. Again,
was there a time limit for the calling off period? Did they suggest the time?
Not that I can see.
I was only asking because there was some research I looked at and it suggested similar results based on a 3-day period. So if you had a losing period, just have 3 days off, don't trade, because I think not only does it make you regroup, but it avoids the overtrading, which ends up costing you money as well. So yeah, absolutely.
Yeah, completely. Right. Number 3, your own brain. Emotions. Bias, the disposition effect, where losses are run for a long, long time.
Ego,
yeah. Our own brain is what does us, really.
Yeah.
So emotional bias, emotional psychology, it can be a killer. It really can be.
It can give you the edge though as well. It can give you the push to get in there.
If you're like a cold-hearted killer.
Yeah. But it's the constant battle, isn't it?
Yeah.
Between admitting that you're wrong and folding the cards, I guess, and moving on to the next one. And just the more you do and the more experience you have, the more conditioned you become to being a little bit more dispassionate with that P&L and going, right, I've got that one wrong, close it, tomorrow's another day.
We're hardwired to be bad at this though.
Yeah,
absolutely. So you mentioned it just there, right? We see clients all the time run huge loss-making positions, and then as soon as it goes green, take it off. It's why we built the trade analysis tool.
Yeah.
So we built the trade analysis tool to show clients what their actual P&L is, because if you run a position for a week, 2 weeks, 3 weeks, and it's not on a forward, you've paid overnight financing every single night, or received it. In fairness, if you're on, you're receiving the carry on an FX pair, or you're short the market, you're receiving. But as soon as you close that trade, we give you the net impact of actually what that is. But it's called the disposition effect. So the ability to take a loss versus take a win. We did it when we did our emotional bias episode, but it's something like twice as likely. It's twice as painful to take a loss than it is to take a
2.5 times.
2.5. Well, the Journal of Finance, it's going back a while now, 1998, so it's kind of considered classic trading psychology, analysed 10,000 trading accounts, and they found that investors were 50% more likely to take a winning position off than a losing position, i.e. there was a nearly 2 to 2.5% chance they're going to let their losers run. And if you think about how that works, if you can't give yourself an opportunity to be right because you're always warehousing those losses, it gives you stress. It's going to mar your decision-making process. It's probably going to, give you sleepless nights. Impact your family, impact your friends. It's really, really difficult. So we're not wired for this. We're fight or flight. If we see danger, we should be trying to get rid of the danger. But in trading, it just doesn't. It's just psychologically, we're just a bit tapped.
I've tried to do something slightly different this year, which I've quite enjoyed having a different mindset, which is whereby if you banked some money and you've got some P&L and you have a look at what you've done on the monthly, or you look at it every week or whatever, I typically go month on month. And if you've got some banked profits, I feel it gives you peace of mind that you can afford to be wrong and close it out, because you're betting those losses into your P&L. So over the year, you can go, right, okay, well, I'm still hopefully net positive. But I think it's that realization that you understand that you're not going to win every trade, and that you're going to have to take some cuts. And cutting isn't a bad thing. It means that you're then freed up to think about the next thing, rather than being burdened with something that's, not good for your account. It's almost like having something that's, it could be terminal for your account if you don't cut it out, basically. And I think having banked gains, I think having some knowledge that those gains are not going to be all yours, because you're going to have to use them as a cushion for some of the losses. Because if you've got a win ratio of, say, 6 or 7 out of 10, then you need to be killing 3 off. So I think that mindset change is a good one, and it's one that a lot of our premium clients actually I speak to, they are so hesitant to take losses. Even if I say to them, look, you've had a monster quarter, you've got huge P&L gain in your trading analytics tool, but you've got a few positions which are, costing you money to run. You don't really like them, but you're just not closing them because you're like, oh, well, I need to get it back on site. Well, you don't. You've made so much here that you could just get rid of them, trim it down, move on, and go back and focus on the products that you did make the money on.
The market doesn't owe you. That's the thing.
No, exactly. And you can't win all of them. You can't.
It's impossible.
So, you might go, oh, I don't want to take the loss. But what about the loss you're paying overnight? You've got to look at it in a holistic way and go, right, what's my overall book doing? And trade it like that.
And I think that's a good point, because the disconnect or the disassociation between winning and losing, where if you look at the net and the overall picture, it's much more easier to digest, but they see them as separate. It's almost like, that's a loss. I can't look at that for now. I'm going to look over here. But it all comes back into the psychology of it. And I think that's where a good trading plan comes in, because you can take the emotions, those out. If you journal and if you have a plan and you can look back, I think those things take out that element of bias, or they reduce them. They take it out.
They try to. I mean, I look after a group of vets that have found options trading, and they will use
veterinarians or ex-traders.
No, veterinarians.
Or war vets, good.
I didn't know where we were
ex-vets. They're now all kind of retired, and they trade high probability of profit option strategies. So selling strangles, iron condors, these things all tend to root around the 85 to 90% probability of profit.
You randomly start looking after these people. This is what you're quite interested in.
What, being a vet?
No, that type of trading.
Oh no, I probably learned a lot more about the tasty product because of these guys.
Right, okay, got you. Okay, got you.
That's why. But even on a 90% probability of profit, you're still going to lose 10% of your trades, which we've obviously had to bump into recently, because if you're on a short vol strategy, vol's blown out at the moment, and so we're nursing and kind of having discussions around how that all sits together.
Got you.
But it's But it's been interesting because the way that this group of people have approached it is, well, they say, well, no, but we knew the numbers on the way in. We knew that across a year, we were going to have a period like this. And I've actually found it quite refreshing to sit there and say, well, we know that we're picking up kind of smaller premiums, but we're doing it with a really high probability of profit in this particular structure. We're going to have bad weeks. We're going to have bad months. Long term, don't worry, I'm totally fine with it.
Well, that's good. I mean, that's a real pragmatic view. And then they will make money because they genuinely got the right mindset, which is that you do have to, you know.
And going back to a previous episode, it's all about maths, right? It's all, that works, it works.
Yeah.
Losing is part of trading. You have to get comfortable with that.
Yeah, right. Oh, actually, it's my alarm. I was trying to stop it before it started going on. On to numero 4, having a lack of trading plan.
Where did that come from?
Well, on the subject of bets.
Just showing off now.
Lack of a trading plan and not having a strategy. We've spoken about it 2 or 3 times already today, but not having a plan means you're basically failing to. What is it?
There's no accountability.
What's the saying?
You don't have a plan, your plans fail.
Correct. Yeah.
There's no accountability. You just basically move on. You never analysing your own performance, what went right, what went wrong.
Prior preparation prevents poor performance.
5 Ps.
Right, it's a different.
I let that come down with me.
You want it?
So now some guy was just spouting it off. To be fair, he was well prepared.
I thought it was a different P to start. I mean, definitely a different P to start that saying, as far as I know. But even just speaking to clients, I know, and I don't have the data to back it up immediately, but I know that people will way overanalyze their entries and leave the exits up to chance.
Oh, absolutely, yeah.
Up to chance, purely chance.
Yeah.
And I've got a client at the moment that will max out their account based on how much margin they have. Okay, so if they've got 20k in the account, they're going to have 19.5 on a margin. The position size is way too big, and they will run it basically until they get margin called. And that is their plan. And you kind of think that just can't be an efficient way to run the account.
YOLO trading.
Huh?
YOLO trading.
It is YOLO trading. and granted, our product can be used for the sport, okay? Right, there is a gambling element to it. It's spread betting, and that's why we can all benefit from the tax-free nature of the product. But consistently, that strategy is not going to make money for you long term.
It's a speculative tool, right? But you want it to be cash generative.
Yeah.
And you've got to have, all these bits and pieces we're talking about. You've got to have a bit of risk management, but right position size, a plan. And the lack of a trading plan is you're basically trying to steer through or navigate your way somewhere without any roadmap or any idea of what to look out for. And you're just hoping you arrive at the destination with a boatload of cash.
Yeah.
Well, when the hell's that going to happen?
Yeah.
So, you've got to have a plan, a reason for entry, a correct size, some risk management in the form of a stop or some kind of hedge or some kind of covered option strategy or whatever. A stop's probably just the easiest, right? And then an exit, whether that's a take profit level or a psychological level or in the event of the news I was waiting for happens, then I'm going to do this. And if you don't have any of that, you're just punting. And over time you won't make money.
Yeah, and that study I read on that website it said that the part of their study, they looked at Taiwan. I don't know why Taiwan, pretty niche, but they looked at trading in Taiwan. And in, I think it was 2002, they introduced a lottery there. Stock market trading dropped 25% when they introduced the lottery. That just shows you how many people were just
Purely using it as a game.
Yeah, because I used a different phrase, but and I keep going back to it, and I always say to clients, you need patience and discipline, and that comes into the trading plan. You need to have a strategy or a structure or a formula in place at the point of entering a trade, stop, limit, and the discipline to stick to it.
Yeah.
Then once you're out of the position, you then need to review it, whether that's in a trading journal or log. You need all those factors. Otherwise, you are just,
You're
pissing in the wind, to say.
I was going to say, having a
I was
wee in the
holding it
wind.
in for so long, sorry.
Well, we've got some data. The Journal of Behavioural Finance, they published some research in 2019 showing that only 21% of retail traders had complete written trading plans. I actually would sell that. I reckon that's too high.
Oh, yeah, I reckon there's a few.
I'd sell that.
I reckon that's way too high. Well, I imagine if this is a study by the Behavioural Finance Journal, they're going to find people that are more into journaling,
behaving
behavioural
financially.
Well, they said so that 21%. They think 21%. So 1 in 5 of the people they surveyed had a trading plan, which I think is too high.
Yeah.
And they said that those that do have documented trading plan tested around 27% better risk-adjusted returns compared to those just shooting in the wind.
Well, I reckon that second point was going to be my point, is that I think people start with a plan, their trading goes right to begin with. They just don't want to be accountable, so they stop the journal and all that. And they just they morph into this sort of punter. And I'd imagine if they then get lucky, they may go back to journaling.
Yeah.
But I think once the plan goes wrong, the accountability is the problem.
Mike Tyson, right? Everyone's got a plan to get punched in the face.
Exactly, yeah.
I think Beachy quoted something like that on the show the other day. It was like a German war general said something similar. It's like everybody's got a great plan until you see the enemy within 15 minutes. But it's true though, right? And I also think that the journal you have to keep, it needs to be easy, because if you're trading more than 3 or 4 or 5 times a day, which is considered a high volume trader, it's a lot of work, right? If you're going to try and set up your micro habit, you know, after was it Micro Habits, the book?
Atomic Habits.
Atomic Habits.
Oh, yeah.
If you're going to set up an atomic habit and try to change your behavior, it needs to be easy.
Yeah.
Yeah,
You have to be able to stack it into your routine, basically, so that it just becomes, habit formed. But yeah, I mean, we work with Axel, right? And he last year, I think he said to me, he managed to trade the whole year without breaking any of his rules.
Really?
Yeah.
Okay.
Which is amazing.
Yeah.
But he's been doing it for 33 years, and he's even still got a trading coach now who's teaching him stuff, right? So he's actively engaged, wants to improve, wants to get better, and is working on it on a daily basis. And he's an expert, and we've worked with him, and I don't think any of us keep a trading plan as such. And I think that it's one of those where we could talk about it, but you've got to try and make it actionable, and like you say, it needs to be maybe condensed. Or if you're trading on your PC, I think it's easy enough to have a spreadsheet or something up next to you where you can document maybe 4 columns of reason for going in, size, mood, outcome, and that's basically it. But if you're going to trade really actively, day in, day out, I think maybe just having a half an hour review at the end of the week, or before the week starts again, maybe Sunday evening, whatever, and you go, right, what looked good, what looked bad, and why were those ones bad? And just try and do that. And our trade analytics basically gives you that. So you can go, okay, over the last 7 days I've made X, Y, Z, and profitable ones are here. These ones not so much. Right, I'm going to stop trading the Dow on a Friday close after a bottle of wine watching the telly. And I'm going to keep trading my stocks at the open when I'm actually watching it. Watching Trade Live IG, reading stuff, engaging with my PCM, and just being ready, being ready to face the market.
You've got to be honest.
You've got to be honest, And it is so easy because the access is there, right? So you could go, the Dow's, those alerts that I've got popping off, they do make you more engaged because you're not staring at the screen all the time, but all of a sudden if you get 10 alerts in a row, you go, something crazy must be happening. And you go in, but you're not really prepared to fully go in because you weren't expecting to trade. So I think it's just being more disciplined with it.
Well, I've journaled in my personal life. So I've not journaled in my trading life, but I've certainly journaled in my personal life when I was having some tough times at home or tough times at work. And you just need to kind of externalize what's going on in your head. And I reckon just having someone to talk to about it, that's exactly why you can call us. That's exactly why you can speak to us. The benefit of having a premium client manager, no plug, but is the ability to talk to someone who is in the market and actually take some of the weight off of you. Because as long as you say this stuff, or as long as you write it down, you're doing a lot better than the person that isn't. But just to round this conversation off then, as a takeaway, the Journal of Trading Psychology identified 6 essential components in any trading plan. So number 1, specific entry criteria with multiple confirmation factors. So you're entering for a specific set of reasons, and that gives you some rules. Predetermined exit points, same thing, definitely. Profit, take profit, stop loss. Position sizing rules, and they say specifically based on your account risk percentage. Market conditions and knowing when the strategy works or don't work. Which weapon are you going to use today because of, which way is the wind blowing? Maximum drawdown limits, either on a daily basis or weekly basis, and then some form of feedback and review for continuous improvement. And if you get those 6 things, that's quite a lot. But you're going to, if you can even get half of that, I reckon you're doing well.
I think maximum drawdown's a really interesting one. If you don't, lots of people don't use stops, and we always say you should use a stop, right? And I still think you should use a stop. But if you're not going to use a stop, I do think you need maximum drawdown in your mind
Yeah.
where you go, okay, I'm going to allow this. Just for those that are listening, don't know what drawdown means. It basically means the level at which the worst point your trade got to before hopefully it turned around and came back.
Yeah.
Now, obviously, we will see a lot of clients that have humongous drawdown and then come back to break even or thereabouts and nip it out.
Yeah.
And obviously there is that get out of jail feeling that we've all had.
Yeah.
But you know, the book sort of says if you're going to let it go that badly wrong, you need to also let it go that right in the opposite direction, right? So I think having an idea of your drawdown, where you say, you know, I've got a 10 grand account and I'm happy to have a 500 quid drawdown.
Yeah.
It's the same as having that stop loss in there, but without maybe you actually wanting to put one on.
Yeah. Well, I've had an honest conversation with one of my clients. He said amongst all of his accounts recently in this tech kind of driven 2025 drawdown, tech sell-off, he's reached his point of max drawdown. So both in his physical long-term investment account and his trading account, and he's stopped trading. And he's gone off on holiday, and I had a call with him yesterday, and he's like, I feel way better. I'm missing out, but actually it got to the point where I was losing money and I was not making valuable decisions.
Yeah.
So, and he would have actually made money if he'd have kept into some of the shorts that he had, but he was like, I would have never held them. So he's using it as a bit of a reset.
Yeah, I had that chat yesterday with a client that I wrapped up the call with, look, it sounds like it's been a bit of a painful period. You can call me at that point. Like, you don't need to only call me in the good times and when you want to meet for lunch. Sometimes it's good to just have a chat, and often I'll just say, look, just have a break. Just have a break, whether it's a few days or it's a week, reset.
Yeah.
And he was really appreciative of that. He thought we were just here for the good times, really. Like, that was it. But no, it's a big part of our role.
Completely. Yeah, completely right. Number 5 is having an unrealistic expectation. So what is a realistic expectation for a trading account? What do you think?
Well, it's all relative, right, to the individual, whether it's a financial amount you want to make, like we said, per week, whether it's a percentage of wins you want to have if you've got the risk management in place. So it really depends on the individual.
But if you think about the S&P, okay, the benchmark, most fund managers will look at, they'll try and use a measurement that they can beat, but the S&P 500 is pretty much used as the yardstick.
Yeah.
And it gives you 8.99, roughly between 8 and 10% a year.
Mm-hmm.
So if you're not making between, you want to have an uplift on that. I think the risk that human nature gives you is you say fund an account with £1,000 and you want to double it to 2, and then you want to triple it to 6. You want to keep going. But in markets, if you were making 20% per year, which is double what the S&P returns, that's pretty good, right?
But you're not going to start there, right? We're thinking about everyone. If you're new to this, I think there are a lot of lessons to be learned, and success ultimately is almost like if you're in your first year and you make money or you break even, I think you're doing all right. You've learned lessons.
Yeah.
I don't think you can come in and go, I'm going to outperform everything straight away. So I think it's on where you are in your own journey, how experienced you are. And most of the people listening to this will probably relatively new. So I think success is just being in the game, being long enough, like those stats said earlier. If you can make it to year 1 and you're breaking even or making money, you're doing all right.
So like a capital preservation, basically.
Initially, I think it's all about that, yeah.
Try and keep it, get some experiences, and then, ideally, try and bank some cold hard cash.
Yeah, definitely, yeah. You want to make money, ultimately. But what I worry with new clients is that initial bad experience through lack of understanding, again, expectations, unrealistic expectations. Okay, I'm going to put 5 grand in, I want to make 25 grand this year.
What happens if you don't?
I don't think, I think the likelihood is going to be, just to be frankly honest with you, is unlikely. You've got no background in financial markets, you've got a job you do full time, how much time and can you apply to it? So you kind of got to set all these things in place and then have a realistic expectation.
Yeah. So the FT actually did a really good survey on this. So in 2020, which is just before peak COVID. Okay, COVID was 21, wasn't it? Yeah,
March
COVID
2020.
So it was 2020.
March 2020,
yeah, you're right. So this was just at the peak then. They polled retail traders, new retail traders, and they said that there was an expectation that they're going to make 34%. So they polled loads of people. How much do you think you're going to make this year? How much do you think you're going to make this year? And they reckon 34, 2020. So if you're expecting to make 34, and this is a grand kind of sweeping statement, but if you're expecting to make 34 and you make 20, psychologically that's going to compound that you've done a bad job and you're going to try and chase more. So I'd be interested to see kind of across a year, how someone's volumes either increase or decrease depending on the first 3, 6, and 9 months as you try and chase that. Well, they call it window dressing, right? At the end of a quarter, that's what big pension funds do. They'll try and maybe push a stock up to a certain level so that they know if it's near a level that they can then say to their investors, oh no, you're up 1% this quarter, 2% this quarter. I guess it's the same thing with options traders, right? You can get this pin risk around a strike where, if the market's close to a particular strike where there's a huge open interest, the market just pushes it above so that they know those are either in the money or out the money. But then you look at, so if retail are looking for a minimum return or an expected return of 34 and the market long run gives you between 8 and 10, it's unrealistic.
I wonder in that year though, obviously given markets plummeted and then there was a big bounce back over the next year or two, I wonder how many we've seen this, right? How many had a great first year going to trading, I want to make this my job. And then when markets get a bit more choppy, it's a bit tougher. And that's when all these other factors come in, whether it's plan, discipline, biases.
But we had
it's an interesting year to do it.
We had some, well, I think it was just because that was obviously the flavour of the month and the FT wanted to capitalise on it. But we had some really successful clients trading out the money Tesla call options. We had a subset, 3 or 4 clients that, during the depths of COVID went really long these out of the money Tesla call options. And when the market rallied up, they had it off. I mean, they were so successful. And I think we checked recently, a lot of those guys have given back all of those profits over the, after the next 3 or 4 years, because what they did was a fantastic trade that may have given you the overconfidence that you're really good at this, yet you've just traded at the right time and picked the right opportunity. How many times do you think that we see a successful client give things back through that kind of psychological imbalance? They've been lucky or they've timed things correctly as opposed to being a consistently good trader, if you want to call it that.
I think, again, we've covered this in the previous podcast, but success can alter your mindset, right? We've all seen people who bought banks after the financial crisis and they did well for a year, but then they never thought the market was going to turn. And they just sat on them, added to positions, never banked any of it. But that in itself is like, you were successful, whether you were lucky or it was by design, but then you've done nothing about it. Like, what were your expectations? Like, I don't know, using just random figures, if you've made £1 million over 2 years, if I'd have said that to you 2 years ago, you'd gone, yeah, absolutely. But now you're there, you've done nothing about it and you've given it all back. Like, the expectations are crazy, really.
Yeah, but do you then, if you are having one of those successful runs, what can you do about it, right? Do you take your funds and you withdraw it and you go and do something else?
Bank a bit is psychologically good. And I think it also gets you a bit, I find when I've done that, it kind of tunes me in more because you can kind of disassociate. Let's say you're up, I don't know, 10 grand on something. You bank 2. Okay, right, it's fine. But then you're zoned in, right, it's gone back. So now I'm only up 5 grand. Well, maybe I should. Whereas I think if you're sat there and watch it go from 10 to 8 to 5, you kind of go, oh, go back to 10. Whereas I think when you've banked a bit, you're kind of more in tune with it. I think that's helped me in the past. Yeah,
and we were talking about this just before we came in. Depending on how how you approach trading, right? If you're doing this full time and you're effectively a small business and you need to cover your mortgage, you need to cover your shopping, you need to cover your monthly run rate, you're not making money for the first week to 2 weeks because you've got to cover costs. If you have a bad week to 2 weeks and you've got to cover costs and you're trying to chase things because you've got, you haven't got any P&L that month, you're going to struggle. Whereas if you're using it as a small pot of capital to supplement income that you've already got, extra to a day job, you're using it to fund the fun money at the weekend, or a holiday.
Yeah, it's less stress, isn't it?
Yeah, it's way less stress,
less pressure on the trading itself.
Yeah. So we ran over on pretty much every single one. But just to conclude then, so as per us 3 apes, the talking shop boys, we're going to say the top 5 mistakes that retail traders make are poor risk management and position sizing, overtrading and therefore paying excessive transaction costs, the disposition effect, emotions and your brain and bias and everything that gives you, a lack of a trading plan and an unrealistic expectation of how to make money. What have we missed?
Oh, that's it.
Not
Nail
much.
on the head.
But what
Can't lose
takeaway
now.
would you give? What would you say to a client? how would you sort of offset a lot of those? What would you refer back to? Because it's hard to go individually, but as a general rule, what would you go with?
I think the biggest takeaway that I've had in recent years, as we've started the show, as we've started to do this podcast, as we've naturally become a little bit closer to the likes of Axel, is have a plan. Position sizing, key, so key.
Yeah.
Use a percentage of your account-based model and put a stop loss on.
Yep.
You do those two things and you're risking 1% of your account. You can lose 100 trades in a row before you blow your account up. The odds of you losing 100 trades in a row are not impossible, but highly unlikely, because you can go back to the episode that we spoke about in maths and you can flip a coin, you're going to get a 50-50 outcome. So if you had a 1% stop, 1% limit, it doesn't matter what condition you're in, over a large enough sample size, you're going to come out roughly flat. So you can try and use those in your favor. I think that's it. Have a plan, use a stop loss, and if you don't, you're with the gods.
Yeah, no, I think you're right. I think that the whole process of trading and the whole thing about your mindset is very important, and that sort of acceptance that you will bank some losses along the journey, hopefully ending up in a profitable place, and basically, controlling that ego within to basically admit you're wrong sometimes, and also if you do get quite a few right in a run of form, maintaining the fact that the market is a cruel mistress and at some stage will give you a slap if you don't respect it.
Yeah.
So you've got to have your stops in place, you've got to have your risk management, and you've got to basically just don't sort of think you've cracked it, because the minute you think you've cracked it, it will turn and it will hurt you because you've disrespected it, basically.
You get smack on the bottom.
Correct.
Pretty quickly.
From Big Daddy Trump.
But mine is patience and discipline. You've got to have the patience to do your back testing, do your research, do your analysis, build a plan. That takes time. You're not going to have one straight away. Then the discipline to stick to that, whether it's good or bad, stick to your limit, stick to your stop. Even if you go awry, because you will go awry, you'll overtrade or trade for no reason, get back to the plan quickly. So patience and discipline, and you'll be on good foundations.
Let's finish it there. I just want to finish as well. We're back to our normal Tradecraft series. In our next episode, we'll deep dive into another topic. I want to give a shout out to our first fan as well. Hey, Pelican 101 on YouTube. You're our first commenter. Thank you so much. It's great to have you along for the ride. Please share, please like. We're now moving all of these videos on YouTube to a new YouTube channel at Trade Live IG. We're going to be pumping loads of content in there. It's going to be tied in with the TV show, and we're going to get YouTube shorts. This is all going to get clipped up. So hopefully you're seeing a little bit more of us on your socials. We'll see you next time.
Thank you.
Nice.